This is a brief video about how a company can capture its sustainable competitive advantage and become a sustainable business. The justification for a company doing that is framed by these big three justifications for a company doing anything. And in the case of what we're talking about, we're saying that if it does the right thing for the environment and society, it will also do the right thing for the company. It allows it to capture new opportunities and mitigate new risks. So it's an if-then kind of relationship between these things that frames the business case. So let's start off by showing what doing the right thing might look like for a company. Increasingly these days, doing the right thing means contributing to the Sustainable Development Goals. Many companies have been doing things on the energy side, the climate change side, the water side, the waste side, the social side for years. And what they're starting to do is to reframe those initiatives around these wonderfully powerful and inclusive Sustainable Development Goals that define what a global sustainable society on a finite planet would look like. So companies are saying if we're going to be doing the right thing, that means that we're doing something useful to contribute to these goals. So is that going to allow them to capture new opportunities and mitigate new risks? That's the business case. And the more we can monetize those things, the better. There's an excellent figure in a KPMG report that came out a few years ago called Expect the Unexpected that shows how that if-then relationship might look. So what we have at the top are things which are described as global sustainability megaforces. And these are 10 of the issues that are on the horizon facing companies, external to the company, that may start to impact the organization in various ways. And these are 5 ways that it's showing. So for example, physical and weather changes could be an impact that is resulting from climate change, and so on. And now a company has a decision to make as to whether or not those impacts are big enough for it to do something about them. So what are the risks of not doing something? What are the opportunities if it were to do something? And that's the way in which companies make decisions. The upside of doing something, the opportunity side, the carrots, and the downside of not doing something, the sticks. And in this figure, that is a derivation of the report that KPMG put out, there are 6 different kinds of risks that are shown here, not the least of which is reputational, as well as the physical risks as a result of things like climate change. And on the other side, we have opportunities. If the company were to actually do something proactively to both reduce its contribution to those global sustainability megaforces, as well as perhaps even come up with solutions to some of them to be more restorative to nature and society, they may find that they can improve their reputation and the value of their brand and the image of their brand, and innovate and learn their way into new products, new services, access to new markets, save a lot of money on the low-hanging fruit of energy, water, material, and waste, and be more attractive to lenders of capital and investors so that those folks are going to be more reassured that the risks that are on the other side of the equation are not going to do damage to the ability of the company to be a thriving, successful business. So when companies are making these decisions, they're normally looking for ways to quantify or monetize both sides of this equation. On the side that's called opportunities, this is the way in which a couple of companies have been able to do very well by paying attention to the sustainability forces that are coming at it from the outside. Unilever, for example, has made a significant amount of savings from paying attention to its energy use, its materials, water, and waste. And it's also found that the revenue streams that are coming from more sustainable products that it's putting out are growing faster than the revenue streams from their more traditional kinds of products. So what we're talking about is that the opportunities available to companies on the cost savings, expense savings side, and the revenue growth side are very, very attractive. And that's part of the mix when we're talking about whether or not this is a good thing or a bad thing for companies to become more sustainable. In the case of Marks and Spencer, they also found that a combination of those savings as well as revenue growth allowed it to increase its profit, which is another way of assessing that opportunity side, by a significant amount as a result of its sustainability initiatives, some of which is coming from its savings. So companies are looking at ways in which they can take advantage of what other companies have already done, unique things to their own organizations as well, and be able to tap into some of those opportunities and avoid some of the risks that are on the other side of the equation. What are that collection of benefits? What is that collection of benefits? This is the superset of all of the possible benefits a company can tap into if it were to get serious about implementing sustainability kinds of initiatives. Many of these align with the purpose of organizations, and companies are becoming significantly more open about what that purpose is. As we talked about before, they can contribute to their sustainable development goals or the world's sustainable development goals and increase their social license to operate in the communities that they are operating in. These are normally called intangible kinds of benefits, but they're very important to companies and need to be part of the decision-making mix. And then we have all of the benefits which can be more monetized. Revenue growth as a result of its better reputation, lots of savings on the low-hanging fruit that we talked about before, more energized and engaged employees that are more productive, easier to attract and retain employees whose values resonate with the values that are being reflected in the company's initiatives on the environmental and social side. Especially on the environmental side, there may be sources of funds that are available to sustainability related projects. The value of their assets, their buildings, and their equipment may also be enhanced by initiatives to upgrade them to being greener. And the value of the stock of the company and the brand value of the company may also be enhanced as a result of initiatives that resonate with the priorities of investors as well. And then at the bottom, there's a whole collection of risks. It's only one line item, but there are about 23 of them that the company can avoid if it were to do nothing by doing something. So that's the superset of benefits. And let's suppose a company said, okay, this looks fantastic. Why don't we just do this? Why don't we just cream off all of the best practices that are being used by other companies out there, and it's not a secret as to what they were, and let's just do them. How good would that be? So if they were to do that and implement best practices, and all of that research that is in the book, The New Sustainability Advantage, captures what those best practices are, they would be able to increase their profits by 51 to 81% and avoid an erosion of their profits of 16 to 36% if they were to do nothing. This is pretty good. And in fact, that range of numbers, by the way, the smaller one is for a small services kind of company. The large one is for a large manufacturing company or a typical large manufacturing company that I ran the numbers for. So what you're seeing here is a range of what's possible. And although it looks big, it's actually quite conservative. I had to factor those numbers down considerably to get them both below 100%. And the reason I wanted to do that was that if they were above 100%, people would have a little trouble believing them. So it was a credibility motive that drove me to lower those down to 51 to 81%. The actual numbers are more like 200 to 300%. So there's huge upside opportunity here for companies simply doing what other companies have already done and avoiding an erosion of their profits if they decide to take a pass on this and their competitors don't, which could start to negatively impact their ability to be as profitable as they have been in the past. So all of the cases behind this claim are outlined in this book, The New Sustainability Advantage. It's an upgraded version of the original version called the Sustainability Advantage, so cleverly called the new one, The New Sustainability Advantage. So on the 10th anniversary of the first book in 2012, I recalibrated all of the benefits, and they're articulated in the workbook. And they're also articulated in some free open source business case worksheets that you can download and play with your own company's numbers to see what might be possible for you. So is there a good business case for becoming a more sustainable business? It certainly looks like there is. And those worksheets allow you to assess that case for your particular situation. So in terms of the justifications used to frame the business case for anything, if you want to become a sustainable business and contribute to the Sustainable Development Goals, it looks like there are some excellent opportunities and risk avoidance capabilities of being able to do that. So I encourage you to take a look at the business case and see what's in it for you to have a sustainable competitive advantage.